Hello students, welcome to my class. This is Professor Vincent Usaga. This is part 2 of chapter 19 presentation. Chapter 19, accounting for income taxes. We left off at this point in part 1. So let's take a look at these facts, and we are going to use this example to illustrate the pertinent issues. So again, C Inc. reported revenues of 130 and expenses of 60 in each of its first 3 years of operations. For tax purposes, C reported the same expenses to the IRS in each of the years. Chelsea reported taxable revenue of 100,000 in 2014, 150,000 in 2015, and 140,000 in 2016. So we are going to take a look at the different amounts in terms of what is taxable between GAAP versus IRS code. Now, let's take a look at the difference or the differences here. For GAAP, revenue is 130,000 each year, expenses 60,000 each year. So we have pre-tax financial income of 70 each year. The tax rate is 40%, so the income tax expense is $28,000 for each year. In comparison, let's take a look at the tax reporting purposes. We recognize only $100,000 in 2014 versus $130,000 for GAAP reporting. Again, like I said, the code or the guidelines in reporting revenue and expenses are different for GAAP reporting and tax reporting purposes. So in this case, we have 100. Year 2, we have 150. And 2016, we have 140,000. So collectively, we have $390,000 in total revenues, be it GAAP or tax reporting purposes. But the difference is due to the difference, or the difference amount is due to the difference between GAAP and tax guidelines. So let's take a look at expenses. Expenses is the same, 60,000 across the board. So the taxable income here is 40,000 for 2014. Again, I want to remind you of this. This is very important in terms of the difference in terminology. So the difference between revenue and expenses, we call it pre-tax financial income. For tax purposes, we call it taxable income. So the taxable income is 40. The pre-tax financial income for 2014 is 70. So 40% of 70 is 28,000. 40% of 40,000 for tax reporting purposes is 16,000. So as you can clearly see, our income tax expense in 2014 is 28,000. Our income tax payable is 16,000. So the income tax payable is actually the check that we issue to the government. So that's what we are going to be paying the government. However, in our books, we are going to report income tax expense of $28,000. So there are differences in subsequent years as well. So let's take a look at the impact of this. So the question is, are the differences accounted for in the financial statement? Yes, they are accounted for. So in 2014, the difference of 12,000 is considered as a deferred tax liability account. In other words, we are paying less. We are paying the IRS less than the income tax expense that we recognize. And the difference, like we said, is due to the difference in recognition. So that $12,000 we are going to pay in the future, so we call it deferred tax liability. It's an obligation that we are going to pay in the future. So that account keeps track of the tax liability that we are obligated for in the future. In this case, it went up by 12,000. Now in 2015, guess what happened? We wound up actually paying the government more than the income tax expense that we recognize. So the deferred tax liability reduced by 8,000, and then in 2016 it further reduced by 4,000. So at the end of 2016, the deferred tax liability account is now 0. Now let's take a look at how we report that on the financial statement. we have talked about how to account for debit, credit in the journal, goes to the ledger, so on and so forth. How do we report it on the financial statements? On the balance sheet, remember that $28,000 in 2014? That was our income tax expense, $28,000, based on the pre-financial income. However, for tax purposes, we only pay $16,000, $12 difference. So for balance sheet, under the liability, we have deferred taxes of $12,000 and we have income tax payable of $16,000. Then on the income statement, as we calculated, we have income tax expense of $28,000. So let's take a look at the second objective. Let's take a look at let's describe a temporary difference that results in future taxable amounts. So what are we talking about here? Future taxable and deductible amounts. These are two issues. Here we are talking about what is going to be taxable in the future and the amount that we are able to deduct in the future. So we call those deductible amounts. So again, what is the difference? Remember we said that the temporary difference is caused by the difference between financial accounting and tax accounting rules as to when to recognize or record revenues and expenses. So that difference, we call it temporary difference, all right? Now, here is two types of differences. We have future taxable amount and future deductible amount. What does that mean? So we say that if the difference in accounting and tax rules make us to pay less now, just like the example we just illustrated, the difference in recognizing revenues and expense makes us to pay less now, then we have future taxable amount. In other words, we have an amount that is going to be taxed in the future, so we call that future taxable amount. Now, if the difference in the accounting and tax rules make us to pay less now than in the future, we call that future deductible amount. So, in other words, in the future, we have additional deduction to take advantage of. We either pay less or we get refund in the future. So let's take a look at an illustration here. In C situation, the only difference between the book basis and the tax basis of assets and liabilities relates to the accounts receivable. Remember, we recognize $30,000 in accounts receivable, which was reported for GAAP purposes but not for tax purposes. So as you can see here clearly, our accounts receivable was $30,000 for GAAP purposes, but for tax, our accounts receivable was zero. All right. So again, the assumption is that $30,000 is going to be received in the future, and when that happens, then we are obligated to pay tax on that $30,000. So we call it a future taxable amount. Now let's take a look at deferred taxes instead of future taxable amount, and we have deferred taxes, deferred tax liability, just like the example we just illustrated. Deferred tax liability represents the increase in taxes payable in future years as a result of the taxable temporary differences as we discussed. So we are going to go ahead and further illustrate the example that we started with. So as you can see here, in 2014, the income tax expense is $28,000 versus income tax payable of $16,000. So there's a $12,000 difference. In 2015, we wind up paying more, in this case $36,000 versus $28,000 that was recognized as income tax expense. Then in 2014, same thing, $4,000. So ultimately, that difference is eradicated. Moving along, still the illustration of deferred tax liability. At the end of 2014, here is the breakdown of the $28,000 that we recognize as income tax expense. $16,000 is current tax expense, and while $12,000 is deferred tax expense. All right. So moving along, let's take a look at how the journal entry is made. This is very important. When we calculate our tax expense based on GAAP rules, whatever we come up with, we call it income tax expense. So we debit income tax expense in this case for $28,000. However, the income tax payable, that is the check that we are going to write to the Internal Revenue Service, is only $16,000. Like we demonstrated earlier, the $12,000 difference is credited to deferred tax liability. That is the obligation that we are responsible to pay in the future. Now, moving along, let's take a look at what happened the second year. The second year, in 2005, the income tax expense is $28,000. The deferred tax liability is $8,000, and the income taxes payable is $36,000. So in the second year, we are paying $36,000 versus $28,000 that we recognize for book purposes as income tax expense. So the $8,000 difference reduced the deferred tax liability. So we deferred $12,000 that we are going to pay in the future. Now, in the second year, we pay $8,000 of the $12,000. So we debit deferred tax liability to reduce that liability. Now, in the fourth year, of course, we do likewise, and the third year rather, and that $4,000 difference is gone. As you can see, the deferred tax liability in the third year becomes zero. So, objective 3. Objective 3. So we are going to talk about the future deductible amounts, all right? So I want you to recognize the fact that here we are talking about future deductible amount versus future taxable amount that we just talked about. It's a big difference, all right? So our illustration talks about zero in on future taxable amount, what we are going to pay tax on in the future. But in this session, we are going to zero in on future deductible amount. So instead of paying more in the future, now we are going to have deductions or refund in the future. So let's take a look at this illustration. During 2014, C Inc. estimated its warranty cost related to the sale of microwave to be $500,000, paid evenly over the next 2 years. For book purposes, 2014, C reported warranty expense and related estimated liability for warranties of $500,000 to his financial statement. For tax purposes, the warranty tax deduction is not allowed. In summary, this is what is happening. In summary, for book purposes, we were able to deduct. For book purposes, we were able to deduct $500,000 because we accrue for it. But for tax purposes, the Internal Revenue Service would not allow you to deduct estimated warranty expense until you actually pay the expense. So that is the difference. And we are going to go ahead and take this from here in part 3 of the presentation.